And I see that euphoria being joined in by some of the largest companies on the planet. Let's take companies like, or known as the Magnificent Seven, like NVIDIA, Apple, Alphabet, Microsoft, Amazon, Meta, Tesla. All of these companies do their traditional business very well. In fact, they do it so well, that they built themselves a very deep moat. And it's very hard for competitors to come in and take away their business models and do something competing. Not impossible, but very hard.
AI is changing the world, but history shows that revolutionary technology doesn't always create great investments. In today's video, we'll break down why today's AI boom is being compared to the dot-com bubble, what warning signs investors should watch, and how experienced investors are positioning themselves before the market changes.
What is a bubble? A bubble is not a fraud or a con or a scam or a Ponzi scheme. A bubble is usually formed around a world-changing idea, a very good idea, not a stupid idea. So it's not the technology which is the problem, it's the investor behavior which is the problem. Investors become over-enthusiastic about the companies which are quoted in that sector, and the prices that they're willing to pay don't reflect the future prospects. Now, I'm not trying to tell you that bubbles are bad. In fact, bubbles can be very good, because from every bubble, some of the world's greatest companies have emerged. The Telegraph produced Western Union and Reuters. The railway boom produced giants such as the Pennsylvania Railroad and Canadian Pacific. Some of these disappeared or were nationalized, but parts of the old Pennsylvania Railroad system eventually found their way into companies like Conrail and Norfolk Southern and CSX. Radio brought us Radio Corporation of America, or RCA as it was better known, television, CBS and NBC, cars, Ford, General Motors, biotech, Genentech, Amgen. The World Wide Web produced Yahoo and Amazon. Then we had the internet as we know it today with companies like Facebook and Google. And we now got the bubble, if it is a bubble, in artificial intelligence. And we don't know who the winners will be. They could be companies like NVIDIA or Microsoft. But what I can say about every bubble in history is, whilst there were some winners, many other companies fell by the wayside. Many of the companies that investors loved during the bubble disappeared, went bankrupt, or never justified the prices that investors were willing to pay. You might remember names like Pets.com, Webvan, WorldCom, Global Crossing, Polaroid, Kodak. Where are these companies now? The question for investors in AI and the associated stocks is how many of the companies that we're investing in today will still be in that business years from now. Yes, there's going to be winners emerging, but along the wayside, some of these companies are going to enter the stock market graveyard. As a collection, I think that investors are pricing in too much growth and too little competition. I'm going to tell you why I think that later on. Let's look at the dot-com bubble in the 1990s. Stocks went to the moon, but when the bubble crashed in March 2000 and NASDAQ started going down, many of the companies which had come to market with nothing more than the word .com at the end of their name and a promise that they were going to change the world, many of them ceased to exist. There were a few who survived, but even the survivors fell very, very heavily from March 2000 for the next 3 years. As an example, let's take Amazon. They fell 80 or 90% in the next few years after the bubble popped. Yet they are one of the survivors. How many companies existed then and have completely gone by the wayside? Were stocks in a bubble from the late 1990s through to March 2000? The answer is unequivocally yes. Stocks crashed in 2000, and what followed is now known as the lost decade for the S&P 500. Although the S&P 500 didn't decline in a straight line, the fact is nearly 10 years later, the S&P 500 was still below the level of its peak in March 2000. I don't think that today's stock market is as insane as it was in 2000. We're a long way from witnessing the worst parts of the dot-com bubble. We're not seeing new companies pop up like mushrooms in the night and being valued as if they're about to change the world. The S&P 500 is currently trading at about 26 times earnings on a trailing basis. That's not cheap. The long-term historical average is in the mid to high teens. So let's call it 16 times, 17 times earnings. We're at 26 times earnings now. So the US market is not cheap. It's expensive. The technology sector is more expensive still. The S&P 500 information technology sector is currently priced at 36 times trailing earnings. The forward price earnings ratio is lower thanks to the growth forecasts for the earnings. But that's the real point. Growth in those earnings have to arrive to justify today's valuations. I am certainly not suggesting that today's market is an exact repeat of March 2000. History almost never repeats itself neatly. The businesses that we're looking at today are much stronger. Companies like Microsoft, Apple, Nvidia, Meta, Amazon, and so on Alphabet have real revenues, they've got real profits, and they have strong market positions, at least in their monopoly areas. And that's very different from many of the dot-com companies which came out in the years 1999 and 2000. But I will say this, valuations are high enough that there's very little room for disappointment. If AI delivers everything that investors are hoping for, those valuations might be justified. But if growth slows, if competition increases, if margins come under pressure, or if investors simply decide that they don't want to pay 40 or 50 times earnings, there's a real danger that prices will come under pressure. Share prices could fall very sharply. The danger is not that AI is fake. It's not fake. It's going to change the world significantly. The technology is not unimportant. It is important. The danger is that investors are placing too high a valuation on the future growth prospects for these companies, many of whom will find themselves in great competition with each other. Based on what we now know, I find it hard to believe that many of these companies will produce enough profit to justify the capital investment they're now making. Of course, there will be winners or a winner, but they can't all be winners. Am I seeing signs that the bubble is getting out of hand? Yes, I am. I think the euphoria around names like SpaceX, where people are buying a dream more than today's profits, is telling me that the end can't be far away. And I see that euphoria being joined in by some of the largest companies on the planet. Let's take companies like, or known as the Magnificent Seven, like Nvidia, Apple, Alphabet, Microsoft, Amazon, Meta, Tesla. All of these companies do their traditional business very well. In fact, they do it so well, that they built themselves a very deep moat. And it's very hard for competitors to come in and take away their business models and do something competing. Not impossible, but very hard. However, all of these companies are now competing in a new area, specifically artificial intelligence. Many of them are spending billions, tens of billions, sometimes perhaps even hundreds of billions on artificial intelligence because they want to be the best, the biggest, the first, the safest, the fastest, and they want their application, their artificial intelligence to be the choice of the end user. And of course, there'll be a great deal of money to be made by whichever company or companies come out with the best tools down the line. And let's face it, it's not just these 7 companies which are involved in artificial intelligence. I just gave their names as an illustration. There are countless technology companies involved in AI in various ways and shapes and forms. And we see their share prices moving around big time every day. But the main thing to say is there's going to be a lot of competition in the artificial intelligence area. So all these companies which are going into it are not going into an area where on day one they have a moat. They probably don't have any moat, and the end user is going to be very fickle. He's going to be choosing the one which suits him best. So which of the AI companies do you think will be the winner? Well, the answer is you can't tell. It's already a very crowded space, and it's going to get more crowded with time. So determining who the winner is today is very hard. I can illustrate that by going back to the time before Google existed as a search engine, Before we had Google, we had a whole host of search engines who were all fighting it out to be the winner in the search engine space. There was Alta Vista, Yahoo, Lycos, Excite, Infoseek, Webcrawler, Hotbot, Ask Jeeves, and probably loads of others. Which one of those was the winner? Well, the answer is not one of them, because eventually Google arrived to compete with them, and Google won on its own by not putting too many ads on the page. Why did Google win? It gave the users a cleaner, faster, and more relevant answer. The same thing's going to happen in the AI industry. We don't know which of the companies around today is going to achieve that goal, or which future company that you never heard of will get there. The point I'm making is they can't all be the winner, or winners if there's more than one. There'll only be a small number who'll make it and become the user choice. The rest of them will have spent their billions, their tens of billions, in some cases perhaps hundreds of billions, on training their software, on data centers, on buying NVIDIA chips and other things for no result. They won't be the winner. And so, of course, they can sell that technology on, and they can sell their data centers, they can sell their chips to other AI companies, but it means that the growth that they were hoping for, the growth that the investors are pricing into the shares today, for most of these companies won't be there in the way that investors are actually hoping at the moment. And when you stop pricing in future growth, the share price comes down to a much lower multiple. As I said, we're at very high multiples today. The average should be 16, 17 times perhaps. And it doesn't mean to say we're going back to the average. When things come down, they often go way below the average, which means that if you're talking about a company coming down, and I'm just giving an example, let's say 32 times earnings down to 16 times earnings, that literally means the share price has to halve. So at the moment, we can't actually tell which of these companies will be the winners. And the way investors are behaving, they're pricing these companies as if each and every one will be the winner. But we know that can't be the case. So when does reality start to set in? When do the winners, the real winners, start to emerge, and the ones who are the real losers start to go out of business or stop doing what they're doing? Well, when that does start to happen, when we start to see some clarity, those which are not going to be the winners will have their growth expectations removed, and the price earnings multiple will come down because there's less growth priced into those companies. Of course, it doesn't mean to say they're going out of business, doesn't mean to say they're going bankrupt. They'll be doing their traditional business, but they won't be doing AI in the way that investors are currently hoping, and that means the growth won't be as high as people are expecting, which does mean that we will have a lower share price for many of these companies. So you've heard me discussing a bubble. Does that mean you should sell everything? My answer to that is that's definitely not what I'm saying. I think you can own a collection of stocks, but I think the most important thing is to be diversified, not only by country, by industry, by style, by size, and by anything else you can think of. So you can buy around the world growth stocks, value stocks, small companies, well-known names, and you shouldn't exclude the emerging markets like China, India, Taiwan, Brazil, Mexico, Peru, Egypt, Chile, South Africa, etc. If you can't buy stocks directly in these countries, you can buy exchange-traded funds. An exchange-traded fund is a fund which holds lots of companies in a particular index, so it's an investor in maybe 10, 20, 30, or more likely 100 companies. So with one single investment, you can get exposure to perhaps 100 companies, maybe even 1,000, depending on the exchange-traded fund. And some of these exchange-traded funds are very focused on the emerging markets. The reason I think the emerging markets are worth considering is, one, they're cheap, and two, they've got high growth, unlike the rest of the world, which is modest growth and rather expensive. So right now I'm looking at investing outside the USA mainly. USA I find a little bit too expensive. I like European companies. I like Asian companies. I like emerging market companies. I like small companies, the small cap sector. But again, if you don't want to take the risk of choosing individual ones, there's plenty of small cap funds. Have a look on and small cap exchange traded funds. If you just Google the words small cap exchange traded funds or emerging market exchange traded funds, you'll find a nice collection comes up which you can choose from. So are we in a bear market? No, the stocks haven't dropped by 20%. A bear market is when stocks have dropped 20% or more. Do I think it's going to happen? Yes, I do. But do I think I should sell everything? No, I don't. I think you should be diversified so you don't worry about the bit which has fallen, and you want to be in companies which are likely to fall less than the market when it happens. These are companies which are going to be like utilities, electricity companies, water companies, companies with fairly stable businesses where things don't change very much from one year to the next. So what I'm saying is, if you're exposed to the US technology sector, you are in a very overpriced zone. So that does, to my mind, mean that we're very close to a bubble popping in that sector. When the AI bubble pops, most of the companies in that high-flying sector will come down. The bigger they've risen, the more they've risen, the faster they can fall. So the biggest risers will be the biggest losers. As I exit my technology stocks, I'm investing in other things in a diversified way. I'm buying other equities, global emerging markets, Pacific Basin, small caps, European stocks, but I'm also buying gold and I'm also buying bonds. Now, I don't like bonds. I'm not much of a fan of bonds, but they can be a convenient parking space while you're waiting for a better opportunity to come along. So I'm just being careful. I'm reducing my exposure to the most crowded and most expensive parts of the market. I'm looking for value outside of the obvious winners and diversifying by country, by sector, by size, by investment style. And I'm keeping some liquidity available. I'm putting some money into gold. So that if markets fall, I'm not forced to sell. I won't be forced to sell because I don't have margin. And I might even be able to buy if I find the right things to buy. I'm talking about ETFs here probably. So whatever you do, do not panic because you're missing out on a rising market. Don't chase it. Don't put all your money into one fashionable story. And don't assume that because the technology is going to change the world, that every stock associated with that technology will make you rich. That's not going to happen. There will be some which could do that, but spotting the winners is very, very hard. And what you think might be the winner today might turn out to be overtaken by competition from another company anytime. So when bubbles do burst, they usually, the bubble itself is built around something real, something fantastic, something which is going to change the world, but investors have just become too enthusiastic. So when it pops, things go down, but then rising from the ashes, you get the phoenix. Some of the companies don't die in that crash. Some of the companies will rise out and become the future mega companies of tomorrow. And some of them will be the companies whose names you know, and there's probably going to be some you've never even heard of. So stay invested, but stay diversified, stay optimistic, but also be realistic. So make sure that if the market does fall, you're glad that you sold something and you've got a bit of cash at hand to buy something on the cheap. What you don't want to be is in the situation where you're forced to sell. Now, if you have margin, if you have borrowing, if you're trading CFDs, if you're using leverage in some way and the markets fall, you might not have any choice. You might be forced to sell at the worst possible moment. And we always see that in a market collapse. There's always a lot of forced sellers at the bottom.
AI may become one of the greatest technologies ever created, but history reminds us that not every company benefits equally. Smart investing isn't about chasing hype. It's about managing risk and being prepared. If you enjoyed this breakdown, subscribe for more market analysis.